because I am calling for a global bust to occur after this melt up, global bust and big bear market to occur after the equity melt up. So I see gold going to 3,000 by, let's say, next summer or before. I see silver going to 60. That's been my target pre-bust. I actually have said of late, we might even see get as high as 75. So, I have a range of 60 to 75 there. Silver outperforms gold. So I think even though it's not going to run right to highs many months, it is going to probably have better day-to-day outperformance or better performance in gold. Both will be up nicely, but silver will probably outperform.
The precious metals market is showing signs of resilience and optimism. As seasoned macro strategist DavidHunter, with 50 years of experience on Wall Street, suggests that the ongoing metals rally could extend into the end of the second quarter and potentially beyond. Hunter, known for his contrarian views, provides specific price targets, forecasting gold to reach $3,000 and silver to achieve a range of $60 to $75. Gold has gained positive traction for the second consecutive day, marking the fourth positive move in the past 5 days. The metal has climbed to a nearly 3-week high, reflecting the momentum in the market. Simultaneously, silver has exhibited new positive trades, approaching the target of $24.60. Analysts suggest breaching this level could extend the bullish trend, with the following positive station anticipated at $25.50. DavidHunter asserts that the bottom for precious metals is now behind us, signaling the beginning of a significant upward movement. Despite gold being close to its all-time high and showing a momentary breakout, silver has faced challenges, experiencing brief breakouts in overnight markets followed by quick reversals. Hunter remains optimistic about gold and silver, highlighting his expectation that silver will likely exhibit better day-to-day outperformance in the long run. Looking ahead to 2024, FX Street anticipates gold prices to average above $2,000, expressing a positive stance for the precious metal. However, some analysts caution that the recent price rally may be overdone. On the other hand, long-term forecasts suggest that silver prices will hit $25 by the middle of 2024 and could reach $30 by the middle of 2025. Silver prices rose by 0.4% to $24.50 an ounce, marking the highest point since December 5th. This comes after a 1.1% gain on Thursday, representing the third consecutive day of profits. Notably, most dollar-denominated metals futures have gained ground, contributing to the positive sentiment in the precious metals market. Let's delve into key moments from DavidHunter's interview with these video clips.
I think metals and miners will be strong in the melt-up. The miners will be among the leaders, I believe, in terms of performance. It's been slow getting started. It's been a very frustrating group for a number of years, but they have bottomed and they have turned up, and they're starting to come out of some of their bottoms now in a little more aggressive fashion. I have said I think the metals and the miners will peak after the market. So if we get a peak in the market, let's say in March or April, you could carry the metals rally into the end of the second quarter, maybe even beyond that. My target for gold is 3,000, and that target is what I call a pre-bust target, because I am calling for a global bust to occur after this melt up, a gold bust and big bear market to occur after the equity melt up. So I see gold going to 3,000 by, let's say, next summer or before. I see silver going to 60. That's been my target. I actually have said of late, we might even see get as high as 75. So, I have a range of 60 to 75 there. Those are huge moves, and moves we haven't seen in, those would be all-time highs for both of those metals if we got there. But we also haven't had anything close to those kind of rallies since we had a very short one after the March lows during 2020. March to August, they ran aggressively. Before that, it was 2016. We had something similar to this. So it's been a while, and a lot of the so-called gold bugs have kind of walked away from the metal and said, forget it. It's frustrated me too many times. So I think we have the conditions now. It's very much ripe for that kind of a move. People are very discouraged by the metals and the miners. And I think that's exactly how bottoms are formed. like I said, I think the bottom is behind us, and we're starting to move out of that bottom. I talk about how they've not done well of late, but I'm really talking about silver because gold is not far off its all-time high. So yeah, gold is acting better than silver has over the last several years, but it's very close to it. It did break out, but it was a very momentary breakout and happened basically in the overnight markets and reversed itself immediately. So that caused people to think that was a top and gold was, giving you a final fake out to the upside and then reversing. I don't believe that at all. I think we had a breakout, but it wasn't ready to keep going. And now it's regrouped, and I think we are going to see new highs here very soon. And once it makes new highs, I think it's pretty clear sailing for the next several months. Silver obviously has a lot more overhead resistance to work through. It's nowhere near its highs of a few years ago. So that one is going to be, probably a little bit harder climb. But typically we find that when you're in a bull market for the metals, silver outperforms gold. So I think even though it's not going to run right to highs, it'll take many months. It is going to probably have better day-to-day outperformance or better performance than gold. Both will be up nicely, but silver will probably outperform.
Hunter is sounding alarms with a stark forecast of an 80% potential peak-to-trough decline in the equity market, a magnitude not witnessed since the infamous 1929 crash when the market plummeted by 90%. Recent market movements, including a more than 1.2% fall in the Dow Jones Industrial Average and a 1.5% decline in both the tech-heavy NASDAQ Composite and S&P 500, highlight the seriousness of the situation. The S&P's worst single-day performance since October and the end of a 9-day winning streak for the NASDAQ and Dow Jones add weight to Hunter's ominous predictions. Hunter suggests that the impending crisis will surpass the magnitude of the 2008 and 2009 financial crisis. He anticipates significant bank failures, particularly in regions like Europe and Asia, are on the horizon. This ominous projection is reminiscent of the U.S. bank crisis in March, which triggered a panic at Credit Suisse in Europe, raising concerns about the risk status of banks operating in European Union countries. The recent shock of a rate increase has cast a shadow over global banking and capital markets deals. The uncertainty surrounding the cost of financing in the wake of the rate increase has dampened investor confidence. In a recent statement, a prominent figure in the financial industry, Morgan Stanley's CEO James Gorman, highlighted the repercussions of the rate increase on banking and capital markets deals. Let's get back to the interview.
I don't typically use the word crash, but it is definitely, it'll fit that description because it's, I think, a peak to trough in the equity market, a peak to trough potential decline of 80%. We haven't had an 80% decline in the overall stock market since 1929 when it was down 90%. So that shows you how dramatic that is. And I think it comes because of an economic and financial bust, meaning an economy that's going to be in real trouble worldwide. This is global, and a financial crisis that I think will exceed the one in 2008-9, which means some big bank failures, more of those concentrated overseas. Europe's certainly a candidate, but so is Asia. So, Canada and Australia, their banks are more leveraged than ours now. We took our hit in 2008-9, and our banks got some religion forced on them to, recapitalize, make sure they have more capital or less leverage. So not that our banks aren't going to be suffering. I think there's less likelihood that we see our big banks go under. However, if it's as big a financial crisis as I think it's going to be, there's a lot of counterparty risk. So you can't rule out that what's going to be hitting all the banking system is going to be hard enough to cause at least one or two over here, some, either close calls or having to be bailed out. So I think that's coming, the melt up first. Because the tightening is over and people have to, run back into the market here, reposition. But probably by the second half of next year, we're in trouble because we are moving towards a recession. We're not in one right now, probably. But we had a strong third quarter, Fourth quarter is not as strong, but it's still above water. I think as we move towards the middle of next year, we'll be in recession, and then that recession spills into something worse because of the leverage in the system. We have, as I like to say, we have 300 trillion, and it's now moved up to more like 320 trillion in global debt. Debt across the globe. A lot of it's sovereign debt, but there's a lot of private debt. And then on top of that, we have quadrillions in notional value of derivatives, which is we're at levels in both debt and derivatives that we've never been at before. Even in 2008-9, we were high. We were at that time all-time highs, but this has gone another level above that. When you have that kind of leverage in the system, and then you have a hiccup or have a problem, it just exacerbates it. So that's why, very simply, we can have what I call a global bust, which we have not had a global bust in the post-World War II era. This is not just a recession. This is something worse.
How has the recent shock of a rate increase impacted global banking and capital markets deals? And what role does the uncertainty surrounding the cost of financing play in shaping the current financial landscape? Considering the comparisons made to the 2008 and 2009 financial crisis, what steps can investors and financial institutions take to navigate the uncertainties and potential challenges posed by the forecasted crisis? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.